Hello, welcome back. In this video, I'm going over how to pay yourself in a partnership. I promise the answer may not be as simple or delightful as you may have liked, but I hope to break it down and simplify it in this video. Actually, this video is from my Paying Owners and Workers course, and I think I did a really good job of simplifying it as best as possible. So I wanted to share it with you in this video because I know so many people have been asking this question. Before we jump in, if we haven't met, my name's Amanda. You're watching The Business Finance Coach, where I simplify business to help you succeed because I truly believe that the world needs what you have to offer. Things like accounting, taxes, and business, these are just tools. I hope to make them feel like accessible tools that actually support you instead of hold you back and keep you confused. So if that sounds like something you want in your life, consider subscribing. Now let's jump into paying yourself in a partnership. Okay, so in this video, we're talking about how you pay yourself in a partnership. And this is like a contractor in that you can just take the money out of the accounts, right? You are going to need to track it, and I'll be talking more about all of these things. The second thing is the primary way that you can pay yourself in a partnership, and it's called guaranteed payments. And I'll talk about how you have to set these up, but like it says, they're guaranteed payments. So they're not based on how well the business does. And so when it comes to being paid and what you're taxed on, we'll be talking about number 3, which is the ordinary business income from the business. And I'll be going over the 1065 and the K1. And then the fourth thing is that you're able to take money out of the business at any time and deposit money into the business at any time if the business needs funds. And that activity will actually affect something called basis. So we'll be jumping in and going through all these, but I know you might be like, well, how do I pay myself though? How do I literally do it? Well, you just take the money out of the business, whether you do a transfer, you write a check, you take cash from cash revenue. It's just going to come down to recording it. In a partnership, you're never, ever paid as an employee or as a 1099 contractor. The business should never issue you a 1099 or a W-2. You're not paid that way. So you're going to just take the money out. Maybe you schedule regular transfers. Maybe you do a one-off transfer. You can do it however you want. It's just understanding how it's going to be categorized and how it's going to affect, right, come tax time. So that's what we'll be going through as we go through all of these in more detail in this video. We can see here, this is the Form 1065, right? And I had a screenshot of this line right here, ordinary business income. An easy way to think about this, it's much like the Schedule C, right? Income minus expenses, focused on only what the business is in the business of doing. So owners are going to share this amount, and it's actually ordinary business income is box 1 on the Schedule K1. This is the form that the owners get, right? And you can see this is ordinary business income, and then there's all these other types of income, gains or losses, or types of expenses, any other types of activities, charitable deductions, things like that are all separately stated throughout the Schedule K1. And then the owner is going to report them on their personal return, and they're going to go into that section, right? If you have other interest income, the interest income from the business is going to be netted. Everyone who's an owner in the business is going to get a share of the business income, and they're going to be taxed on that. How you're taxed on this, if you work in the business, you're going to pay self-employment tax. It's like working income. If you're an investor, and investors in partnerships cannot work in the business, but if someone is that investor, then this is going to be treated as passive income. And that comes back to the operating agreement. That's not like arbitrary that you can like say every year. It's based on the operating agreement, and it should be amended if it's different. Now, the one other thing we've got to add in is this line right here. And this is an expense, it's a deduction for ordinary business income. And this is guaranteed payments to partners. If your operating agreement specifies that one partner is going to get a salary, regular payment, amount of money, then it's allocated to that partner. And that amount goes here and decreases the ordinary income that everyone is taxed on here. And then that partner will have their guaranteed payments reported here or here. So really, it makes sense to use this guaranteed payments for partners, but for it to qualify as a guaranteed payment, it has to be defined in advance, and the partner has to get it regardless of how well the business does. But the advantage to this is that it makes sure that the person who's working, who's taking money out of the business, is paying taxes on it. So that's how you're paid in a partnership, okay? It's either guaranteed payments or you're taxed on ordinary business income. That's your pay. However, in reality, people can take money out anytime, and people may need to put money into the business anytime. So just like for the single member LLC, each partner has a capital account for the accounting records, and they have capital contributions and capital draws for each partner. And that's all that means is money taken out, that's not guaranteed payments, money put in, that's contributions. And that doesn't show up anywhere here. What that affects is basis. And as you may be aware, there's an entire course on basis. So someone could take a lot of money out of the business, right? Say a business makes a lot of money. Say there are two partners. One partner's off doing some work. The other partner is running the business, but actually has a huge boom in the business. And the other partner doesn't even know. And they're taking money out, going nuts. And come the end of the year, they had say, ordinary income of a few $100,000. No partners had guaranteed payments. Well, that other partner who didn't know about this is going to be taxed on half of it, even if that other partner took all the cash out of the business. If it wasn't categorized as guaranteed payments, they're going to be taxed on it. Now, those contributions and withdrawals, that's kind of the default if you don't have guaranteed payments, but that doesn't come into play until you're either deducting a loss or the business is closed, you've sold your share. Because it's an asset, we're going to have a gain or loss calculation. So basis is increased by things and decreased by things. When you put money into the business, it increases basis. When you take money out, it decreases basis. You can never go negative on your basis, and you can never, therefore, deduct a loss coming from here that would take your basis negative. So, and obviously, once you start withdrawing, if you withdraw too much money, more than your basis of draws, then if you go below zero, you're going to be taxed on that money. Okay, so that's about all. Just to reiterate and recap what we covered here, essentially, owners have three different categories going on in a partnership. They are never paid as a W-2, never as a 1099, ever, ever, ever. Instead, the net ordinary income from the business, each owner is going to be taxed on their share of that, as well as the other separately stated items. Now, how they're taxed on that business ordinary income, their share of it, depends on whether they work in the business or they do not work in the business. If they work, it's self-employment, working income. If they don't, it's passive income. If the operating agreement defines that a worker is paid a salary regularly, then that salary is categorized as guaranteed payments and is deductible. And that also includes things like health insurance. Those guaranteed payments are then reported for that partner to pay taxes on it as working income. Lastly, owners may withdraw money and put money in at any point in time whenever needed, and that is tracked in the partner capital accounts in the accounting records, which is going to affect their and the business's basis. It's called inside and outside basis, in the business, and that gets super complicated, but I have another video that goes through that, and I'll be sure to link those videos below. If you want to get a hold of my free business spreadsheet template that goes over basic accounting, quarterly taxes, and end of year taxes, be sure to check out the business spreadsheet template. It's totally free, comes with a free training, start the year off right. And of course, if your business is bigger, you have more going on, then be sure to check out my small business school, which includes the paying owners and workers course that this clip was from. Otherwise, I'd love to hear from you in the comments below, or I'll see you in the next video.